Then you got the whole MSTR craziness. You know about that, right?
No, what's going on there?
That's MicroStrategy.
Right. The
It's,
Bitcoin thing.
yeah, they own all this Bitcoin, and so they're rocketing up. I think they were the second biggest.
150% year to date.
Yeah, I think that's the second best behind Supermicro.
Yeah.
And yeah, so they're the same type of deal where they're in the Russell 2000, but they're huge now.
Right.
Like the market cap is. So yeah, they'll get kicked out of that, but I can't imagine the S&P committee taking that on. You know, they're not going to touch that with a 10.
Well, because you need the profitability. Like they're not going to hit the
well,
profitability.
Bitcoin just needs a dividend, man.
Right. Hey everyone, welcome to the Nasdaq Dorsey Wright podcast for the week ending on April 5th. My name is Ian Saunders. I'm sitting across here with Chuck Fuller again. Chuck, good to be sitting across the table from you.
Yeah, good to be here.
So for those who might not know, should, because you're a regular back on the podcast at this point, but Chuck is one of the portfolio managers here at Dorsey Wright. And so felt it would be good as we move into the second quarter of 2024 to kind of get your take on what we've seen in Q1, maybe some things to look toward in Q2, and just kind of what you're looking at in the market right now. And I mean, in looking at the market movement throughout the first quarter, pretty solid start to the year. It's something that I think a lot of people, I mean, I don't know if it was didn't expect. I mean, you had a lot of people calling for potential corrections or stuff, but things just kept storming higher and momentum did pretty well also.
It did, yeah. I mean, yeah, coming off the October low, like you said, you had a lot of naysayers out in the market. And you know, maybe for good reason. You know, the market doesn't often move up this much this quick.
Right.
You know, we've seen some things from the past, and when the market moves up, this much this quick, it might not mean good things, at least over the short term.
Mm-hmm.
So far, those haven't come to fruition, though. Like you said, you know, we probably moved up through the end of January. I think we were up, roughly 20%, off that bottom. You know, sometimes, in the next 2 or 3 months, it can look pretty bad, but it's been remarkably resilient. A lot of these indicators that we track have stayed, at high levels. And that's kind of a sign of a bull market,
Yeah.
right? Like, when you get into a bear market, a lot of those indicators, whether we're talking about bullish percent charts or positive trend charts, they tend to be more symmetrical in the sense that when they get high, okay, you can start looking for them to come low. Right. When they get low, time to start looking for them to move high. When you get into a bull market, it's good when they get low because you can buy the dip. But when they're up at high levels like they are now, they can just sit there and coast.
Right.
And that's what we're seeing. So it's been a good thing. Obviously, like you said, momentum is up huge. It's having one of its best years that we've seen in a long, long time.
Yeah, and we see that in that looking at it as performance quilt of different factor exposures, right? This is the piece we put in the report on Monday, as we typically do to start off each quarter. And so the kind of momentum ETF, your classic, more academic momentum focused MTUM, right, up 15.5% in the first quarter of the year. Back as the best performing factor representative. You had the S&P up, 10.4 almost, right?
Yeah, right.
So you're seeing something notable improvement from momentum. And I guess that's probably because you had areas that were doing well last year continue to do well this year. So that allows momentum to capture that outperformance, right?
Yeah, I think a big part of this too is, we didn't get what I call like a reshuffling of the deck,
right,
at the bottom. So the bottom back in October, a lot of times what will happen is that, as the market moves down, you rotate into, let's say more defensive stocks, whether it's, utilities or consumer staples, whatever it is. And this time that didn't happen. So, pretty much all through the correction, what was hot before stayed hot. So things like technology, industrials, so on and so forth.
Mm-hmm.
And so that allowed us to still hold on to those stocks. And when I say us, I mean, sure, our products, but also momentum in general, just allowed it to stick with these stocks that have been doing well, for so long, and just kind of carried the baton up.
Kept on rolling. But when we look at that, you look at like sector breakdowns. We were just talking about this before jumping on. I mean, technology is still at the top of our sector rankings and still overweight in many kind of more momentum focused strategies, but it was not the best performer in Q1. right? I mean, from a sector perspective, you had
Yeah,
energy showing some of the most improvement, which
yeah.
might be something kind of interesting to look toward in Q2.
Yeah. Energy is interesting. I don't think it's getting a lot of play
Right.
from people, but yeah, it was the best performance sector. And technology actually underperformed the market by a couple percent. And I feel like a lot of people, you tell them that, what are you talking about?
Yeah.
Nvidia and Supermicro computer, or
Microsoft's doing well.
yeah, Microsoft's doing well, like all these things doing so well. And I will say, like, a lot of that comes down to Apple, right? I mean, it's down 12% for the year. It's a huge weight in these technology focused indexes. And so, but when you look at something like energy, that's done so well, I would say that it's pretty much all those stocks are going up, and it makes sense. Crude oil's up almost 20%, year to date. You've got Exxon, which is the biggest stock in the oil sector. It's up 20%. And then you got other names like Marathon Petroleum up over 40%.
Wow.
Year to date. So it's something to look at. And I think we were talking a little bit before this about you had seen some research about Q2 being favorable for energy.
Yeah, so we put this in the report on Monday too, actually. But looking at how different sectors do, kind of broken out by quartile, and specifically looking at the second quartile. So if you throw out communication services and real estate, because there's more recently defined sectors, right? You're just looking at your kind of core old school basic sectors. Energy is the best performer on average in Q2 since 1999, up a little over 4% on average in the second quarter. Whereas the market, for perspective, is up just over 2% on average.
Gotcha.
So almost like doubles the average return of the market in the second quarter. So I mean, maybe that's some strength that we'll see that momentum carry through, right?
Yeah.
Over the next few months. I mean, that's not something that's not like an overweight in most strategies right now, right?
Yeah.
But if it keeps that up, I mean, the expectation would be you might see some.
Yeah, you could easily see it come in.
Right.
And it's interesting. It's not across the board either. It's one thing I was thinking about. Where crude's up 20%, the other side of that is natural gas, right, which is down 25% year to date. And I just think it's a remarkable story, going back to 2022 and everybody thinking that, Europe was going to be in some kind of massive crisis because of the Russian war, and then, cutting off, natural gas from Russia. But since then, since that peak of worry, I mean, we're down 80% in natural gas. I mean, it's unbelievable to me.
Wow.
Yeah.
Yeah. And commodities in particular, I mean, we're just looking at what happened in Q1, or even just in the month of March, we saw commodities gain more signals in our dollar rankings than any other asset class. Moved up 10 signals. Yeah. Now it's still firmly in that third ranked position. It's not in danger of overtaking international. Domestic equity is still solidly in that top spot, but it's other, I mean, crude oil, certainly a lot of that's from crude. Gold's at all-time highs, right? I mean, it's
don't forget cocoa.
Cocoa is hard not to forget. I mean, you're talking about a meteoric, almost NVIDIA-like rise.
Yeah.
That is.
I mean, that is crazy, because we were looking like NVIDIA's up 80%, and cocoa's up almost 140%.
That's
year to date.
Yeah.
So,
that's so that's definitely helping out some. It's the breadth in commodities, not just crude.
Yeah, it's not just crude. You obviously have other areas, and actually if you look at the I think it's the S&P GSCI index, which is heavily weighted towards crude. It's done better than the S&P as just a broad index too. Year to date.
ETF representatives, I guess given the fees and the commodities, the ETF a little bit different, but it's like you're up 9.97 versus 10.4.
Yeah, they're like neck,
so they are like right there.
Right.
But you just, I mean, for some of the broader, longer term rankings, or for that exposure to shift, I mean, you're going to need to see that kept up.
Oh,
right?
yeah.
I mean, that's kind of the deal. We're not seeing weakness from domestic equities that would lead to rotation.
Yeah.
I mean, we mentioned there as well, kind of looking at areas within domestic, looking at some areas in commodities in third, but international equity sitting there in the middle position, it continued to pick up some strength. I mean, from a broad relative strength perspective, and the Dolly rankings picked up more signals than domestic equities in Q2. And when you're looking at international equity exposure, I mean, we saw the outperformance from momentum also play out pretty well there in the first quarter too, right?
Yeah. So we have some products that look at that, and one of them in particular, it's done better than its benchmark, which is the AADR is the ETF that I'm talking about. So yeah, we've seen it there. Still it's tough to beat the US.
Yeah.
Right. I think I was looking at it earlier and only 6 countries year to date, have beaten the US.
Yeah.
So it's tough there, but yeah, we're seeing more strength, interestingly, out of, developed and those kind of areas than we have been, maybe some of the more emerging. Latin America is still high in our rankings, even though it's kind of pulled back a little bit lately.
Mexico is doing really well. I know that's one area. It's been more Mexico, less Brazil recently. In looking at like the country rankings.
Yeah, and I think even like Colombia is like
Colombia and Peru are doing pretty well. Yeah.
Right. So yeah, there's it's not just a US game out there. There's definitely other things to play, but US is certainly dominant.
So when you're looking at, and I'm just looking back like the performance quilt, we do the same kind of factor quilts for like developed ex-US equities as well. If momentum's the best performing factor in the developed ex-US as well. And if you look historically, it has been since 2009, so 16 years looking at, it has been the best performing factor in 7 out of those 16 years.
Yeah.
Way more so than anywhere else. Why do you think there's just more opportunity for focused strength in international, or why is that?
Yeah, I think that the big thing is that the broad indexes haven't done nearly as well in the international markets as they have in the in the US. Right. In the US, the S&P has just been so dominant. Large cap growth has just been dominant. But international is completely different story. It's much or more stocks that are able to outperform the broad benchmarks there, and momentum picks up on that, right? Like if you only have a few stocks that are really able to beat the market, then it's a harder game for momentum.
Yeah. So even if it's not like international as a whole might not be doing better, but the momentum aspect in general, trend following is certainly working out well there, at least on a year-to-date basis too.
Exactly.
When you're looking at areas that haven't done well from a domestic perspective, fixed income obviously is top of mind at the bottom of the list.
Yes, exactly. Yeah.
Across most of our broad rankings, but we were talking a little bit too about, given the fixed income's been doing poorly, it's hard to kind of capture a lot of outperformance from fixed income because the whole asset class hasn't been doing as well, right? But there's some kind of interesting stuff that you were looking at that you're seeing volatility come down in fixed income, which might provide more opportunity.
Yeah, I think it will. So, looking at something like the MOVE index, which is basically like the VIX for bonds, right?
And for those on our site, the ticker is just ML Move.
ML Move, right. So looking at that, it's really collapsed here lately. Even with, rates kind of sort of spiking here of late, it's just really been moving down. And it's actually gotten back to its long-term average value, which is around like 90 or so. Basically since the beginning of 2022, I think the average is more like 120 when I was looking at it the other day. So, roughly 30% higher. And that level of volatility, what that means is that it's just going to be harder for, us to capture trends, because the trends are they're changing all the time due to volatility. And so it's basically, it's like, you might even get a certain direction, like, largely we've, kind of moved down in fixed income, but there's been so many moves back and forth because of the volatility. It's easy to get kind of suckered in on the way down.
More propensity for like false signals.
Exactly. Yeah. And so what I'm thinking is going to happen now is that, we go back to more, historical averages on volatility. That gets us back into a more normal market environment where these things, work out. And I feel pretty good about at least momentum's ability to provide outperformance within the fixed income space moving forward from this point. Because of that, if we get back to a more normal market, really if you want to be dead on, it's kind of like what we're talking about with international, fixed income provides a space where historically it's much easier to beat the benchmark than it is in the US equities market. And it maybe not by the, similar magnitude, but you can, you tend
relative
to get
magnitude. We deal with relative.
You tend to get more consistent outperformance. There when you're in a normal market environment. And I think that's where we're heading back to now.
And so with that, some of that movement you've seen in volatility coming down a little bit in terms of the MOVE index, right? Rates have kind of remained backed off a little bit, certainly from highs last year, but
Yeah.
haven't been tumbling.
Yeah, they're stumbling, or I should say, not stumbling, but they're being stifled, right?
Right.
Like
Stumbling, maybe not tumbling.
yeah. So yeah, they pull back certainly,
Right.
not to the degree we'd like to see.
Yeah.
And I mean, I think everybody, if you're following financial news, you kind of know the deal there. Markets are expecting what, like 6 rate cuts,
Yeah,
and then now that got dialed back. At least it got dialed back to the Fed's target, which was more like 3,
Right.
and then now it's okay. Maybe there's going to be fewer than that. So I think it's the type of thing where directionally we all kind of know where it's headed, barring some major calamity. But the steepness by
Right,
which we
right.
get down to the levels it seems to be changing.
But let's say we hung around, right? I mean, so if you're looking at like the broader charter TNX, right? It like peaked a little bit above 4.3 in 2022, fell off, then rose all the way up to almost 5, and then fell off to 3.8, and now it's back to like 4.4,
Right.
or 44 on the chart technically. I mean, if it like hung around their whole higher for longer deal, if it like hung around, what kind of environment does that look like for the more trend following? Is it good? Is that bad? Is that
Yeah, and I don't know. It's staying at the same area probably isn't bad.
right?
It's all about the volatility of it, and that's kind of what we were getting at before, right? So you just had so many crazy moves back and forth the past couple of years.
Yeah.
Actually, if it just stayed here, it'd probably be fine.
Okay.
Right?
Yeah.
And it starts to move down, even I would say if it comes back like super sharp, that might not be the greatest.
Yields down, price up.
Yeah. Well, yeah. So if yield go down, price goes up, that's good in a sense.
Right.
For a momentum strategy, that if it does it too quick, or it's too volatile, it might be hard.
You want those more consistent trends.
You want the consistent trends that aren't just like breakneck, one direction or another.
Right.
But yeah, like I said, I do think that we're probably entering back into a more normal period where we can expect better things. That's a low bar, but better things out of fixed income.
Better things moving forward. Well, I mean, if we can keep that going, and you got good things on the domestic side, good things on the international side, and get momentum and fixed income to pick up too. I mean, that sounds like not a bad Q2 in my book.
It does. Yeah, I think we're poised to have a pretty good time.
Yeah.
The rest of the year. So we'll see.
Yeah, that'll certainly be some pretty interesting points to keep an eye on as we head through April, into May, into the summer, getting that fun seasonal shift coming up soon, which I'm sure we'll have a lot to talk about.
Oh yeah, absolutely.
Well, with that probably wraps up what we're looking to hit on here this week. So Chuck, thanks for hopping on.
Yeah, no problem.
And we'll be back to touch base with you all next week.